Elon Musk recently came to Twitter to explain how the US is entering a horrific crisis due to the war in Ukraine. In the tweet, Elon said, "Hate to say it, but we need to increase oil and gas output immediately. Extraordinary times demand extraordinary measures." In a follow-up tweet a few minutes later, Elon wrote, "Obviously this would negatively affect Tesla, but sustainable energy solutions simply can't react instantaneously to make up for Russian oil and gas exports." Elon was referring to the world's dependence on Russian pipelines, which hasn't really stopped many governments from sanctioning Russia after its invasion of Ukraine. That said, it has still sparked fears over surging energy prices, particularly in Europe. But Elon didn't just stop at gas. He's called for a boost in Europe's nuclear energy output as well. The Tesla CEO tweeted, "Hopefully, it is now extremely obvious that Europe should restart dormant nuclear power stations and increase the power output of existing ones. This is critical to national and international security." According to a compilation of data from the International Atomic Energy Agency and the World Nuclear Industry Status report by Bloomberg, Europe is on track to be home to 102 shut-down nuclear reactors at the end of 2022. According to the International Energy Agency, Russia supplies about 1/3 of Europe's gas demand. The continent has come to depend on Russian natural gas exports as a transition fuel as most countries move toward renewable energy. But the shift to renewables has not been fast enough for the EU to ease its reliance on Russian gas. Germany, in particular, relies on Russia for more than half its gas demand, as the country has been phasing out nuclear energy since the Futurity nuclear disaster in March 2011. Reuters reported that Germany's last 3 nuclear plants are set to close by the end of 2022. But due to current events, it is now considering delaying the country's planned exit from nuclear energy and coal. According to Elon, nuclear is much better for global warming than burning fossil fuels. In a follow-up tweet, Elon claimed that the notion of radiation risk is a mistaken one and laid down a challenge to his critics, saying, "For those who mistakenly think this is a radiation risk, pick what you think is the worst location. I will travel there and eat locally grown food on TV. I did this in Japan many years ago, shortly after Fukushima. Radiation risk is much lower than most people believe." According to a press release from Solar City, Elon visited Fukushima in July 2011, just months after its nuclear accident. There have been 2 major nuclear plant disasters in history, at Chernobyl in the former Soviet Union in 1986 and at Fukushima in 2011. A UN study released in 2021 said it found no adverse health effects among Fukushima residents directly related to radiation exposure from the accident. Energy Intelligence reported that Russian oil exports have fallen by 1/3 due to a whole lot of Western sanctions against it over its unprovoked invasion of Ukraine. Although the sanctions don't specifically target exports of Russian oil and gas, the trade media outlet reported that there was a general reluctance among buyers of Russian cargo. The developments have caused oil prices to spike to all-time highs, sending gas prices at the pump soaring. There's no doubt the world needs to produce more oil ASAP, but where would it come from? As we mentioned, Russian oil is steadily disappearing from the market, as refiners and traders increasingly view it as toxic and overly risky due to rising sanctions. Millions of barrels of Russian oil per day are currently going unsold as a result, putting more stress on an already undersupplied market. It's become increasingly evident in recent months that most of the OPEC and OPEC Plus countries, which basically control the world's oil reserves, lack the significant spare capacity to increase production. Now, it seems only Saudi Arabia and the United Arab Emirates appear to possess significant excess capacity. According to news reports, negotiators are close to striking a nuclear deal with Iran, which could add 500,000 to 1 million barrels per day back into the markets in a fairly short amount of time. In the US, domestic drilling has been slowly going up. In the Permian Basin in Texas, the most prolific US oil field, the number of active rigs is approaching pre-pandemic levels. There are 248 more rigs running than there were just a year ago. So far, most of that activity involves wells that were drilled previously and not completed. By drilling through their inventories, oil companies have been able to take advantage of higher prices while still delivering the financial discipline investors demand. But eventually, their backlog will run out. Some private companies are starting new drilling programs, and they're looking beyond the Permian to lower producing basins they've abandoned in the past. Oklahoma's Anadarko Basin and the DJ Basin in Colorado, both of which saw drilling grind to a halt mid-2020, are now experiencing a revival, even if it's on a smaller scale. And while Wall Street and private equity funds have shifted their focus to greener investments these days, the recent price increases have left oil companies in piles of cash. Clark Williams Derry, an energy finance analyst with the Institute of Energy Economics and Financial Analysis, said, "I still hear complaints about how oil and gas are getting frozen out of bank financing over climate and environmental, social, and governance concerns. But honestly, with the amount of cash they're making right now, a lot of them don't actually need banks. They're generating plenty of cash on their own." To his point, the 7 biggest Western oil companies, which include ExxonMobil, Chevron, BP, and Shell, are about to embark on a buying spree of their own stock. Research firms estimate that they will spend between $38 and $41 billion buying their own shares, which in turn will boost their stock values and, of course, their executive compensation. That's roughly double the $21 billion these same companies spent on their shares during the last boom in 2014. They may be talking about energy transition and net zero initiatives, but they are reaping a windfall from surging post-pandemic and wartime oil demand. That demand is showing little sign of going down, even as gasoline prices soar. In the past week, average pump prices for regular unleaded in the US rose almost 4 cents a gallon to $3.53, or about 90 cents higher than a year ago. In California, average prices are closing in on $5 a gallon, and San Diego County just reported the highest gasoline prices in history at $4.74 a gallon. OPEC and its partners agreed to boost production next month, but the relatively low increase of 400,000 barrels a day has already been priced into the market. The Biden administration has been pressuring OPEC for months to open the taps, but its pleas have been ignored. Russia is one of the biggest crude oil producers, and analysts have predicted that with some of its supplies likely to be diverted to the war effort, oil could rise as high as $170 a barrel if OPEC doesn't step in. That could push average US gasoline prices over $4 a gallon, long thought to be the threshold at which demand begins to fall. Last year, when the pandemic was the biggest of our problems, Biden was already so desperate that he asked US shale producers to step up production. Shale is a sedimentary rock that is used to make bricks and pottery, but that's not what Biden wants it for. Natural gas and petroleum can be extracted from oil shale. Speaking to Bloomberg, Scott Sheffield, the chief executive of Pioneer Natural Resources, said that shale producers can't save the US because investors haven't eased their demands for returns. The minute they see companies expanding their drilling programs and trying to grow again, they're likely to cut back on funding. Even if producers had the capital, though, the CEO believes that they don't have enough people to drill new wells. Sheffield said, "Several other producers are having trouble getting frac crews. They're having trouble getting labor, and they're having trouble getting sand. That's going to keep anybody from growing." According to the Texas Oil and Gas Association, the oil and gas industry has almost 66,000 job openings in Texas alone. But even with an average hiring rate of 2,633 a month, the industry has a long way to go to full employment. Also, the oil patch isn't immune to the inflation affecting the rest of the country. Production costs from shale formations rose as much as 15% in the second half of 2021, and it could increase by another 6% this year alone. According to the Pioneer CEO, only Saudi Arabia or another major OPEC member has the capacity to affect the market quickly enough to bring relief to US consumers. The big question remains whether the Putin-led spike in prices this week will be the motivation that the oil companies need. Elon's shocking remarks sure help that cause too. They alone probably can't pump enough oil to make a difference, but if one breaks ranks and starts drilling, others may follow. And as investors start to see their opportunity to make money, they may finally start putting more funds back into the industry. Until next time, welcome to the future.